Okay, perfect. It's recording as well for
Thank
now.
you. Okay, hello everyone, and welcome to today's session, which is supported by Rethink Economics Warwick. My name is Farzad Javidanrad, and I hope you will enjoy listening to and having a debate with our panelists. Zoom automatically records and stores the webinar, and we were hoping to publicize the recording at a later date so that more people can gain from the debate. First, let me introduce the members of our panel. On the alphabetical order, our panelists are Roger Farmer from Warwick University. Roger is a professor of economics at the University of Warwick and emeritus distinguished professor of economics at UCLA. He holds a position in the management team of Rebuilding Macroeconomics, an initiative charged with funding creative ideas in macroeconomics that are relevant for economic policy. He has focused on the connection between market psychology and macroeconomics, sometimes something that Keynes actually formulated in his early works, but has since been largely forgotten. In his latest book, Prosperity for All, Roger has argued that governments need to adjust to modern day conditions and pursue financial sovereignty and intervene directly in asset markets to ensure a stable economic prosperity. We have also Fadel Habub from Denison University. Fadel is Associate Professor of Economics at Denison University and the President of the Global Institute for Sustainable Prosperity. His research focuses on financial sovereignty and job creation programs, as well as political economy in the Middle East. His work has built upon MMT, modern monetary theory, arguing that countries need to develop policies that will help them achieve financial sovereignty, which in turn enables them to achieve full employment and sustainable prosperity. Also, we have George Salgin from Cato Institute. George is a senior fellow and director of Cato Institute Center for Monetary and Financial Alternatives. He is the editor-in-chief of the center's blog, Alt-M. He is also professor emeritus of economics at the Terry College of Business at the University of Georgia. His research covers a broad range of topics within the field of monetary economics, including monetary history, macroeconomic theory, and the history of monetary thought. He is also one of the founders of the modern free banking school. Also, we have Eric Timoy from Lewis and Clark College. Eric is an associate professor of economics at the Lewis and Clark College, as well as research associate at the Levy Economics Institute of Bard College. His research has focused on themes in macro and monetary economics, and his current research agenda includes nature, history, and theory of money, as well as the coordination of fiscal and monetary policies. So we have about 120 minutes. This one is dedicated to monologues from each of the speakers. We will start with a 5 minutes introduction, which is finished at the moment. So if you allow me, I just try to ask about the questions very broadly. We want to talk about sustainability of debt, and also we want to talk about the monetary policy and its position at the moment, considering with the situation we are in with COVID-19. So if monetary policy has anything to do at the moment or can do anything with this kind of situation. So I just finished here to give time to Roger to talk about these questions. Thank you, Roger.
Okay, thank you very much, Fazad. I'm just going to see if I can share my screen. So, can you all see that?
Yes.
Excellent. Okay, so I'd like to start out by thanking the organizers of Rethinking Economics for inviting me. And I'd like to start by saying a little bit about the questions that we were given to try to answer. And here are some of them. I'm not going to be able to get to all of these questions, and these aren't even all of the ones that were on the list, but they're the ones that I think that it would be most productive for me to spend my time talking about. So the first question was on the sustainability of debt, and in particular, the question, can we spend our way out of COVID-19? I've put a little parenthesis there, fiscal policy, because I associate spend with increases in some sense of transfers or government spending. The second question under sustainability was, might we slip into a bad equilibrium? So I'm going to spend probably much of my talk in the next 25 minutes on addressing those two issues, and we'll see how far I can get on some more of those questions, which was, can monetary policy stimulate economic activity? And there are three sub-questions there. What happened to the Phillips curve? That's something I've written a lot about, and I'm happy to talk about that maybe in the discussion. Why has aggregate demand slowed in Western economies? And how do we escape from low inflation? So that's the second set of questions. So let me first of all then turn to the first two. Can we spend our way out of COVID-19, and might we slip into a bad equilibrium? So my answer to the first question is yes, but let me be a little more precise about what I mean by that and about what the particular crisis is that we're now in. So the recession that was generated after COVID-19 back in March was unprecedented in the history of advanced Western economies. It was not a recession that was caused by some kind of supply shock. It wasn't even really a recession that was caused by some kind of demand shock. It was a recession in which we were all mandated to stop doing what we would normally do in our daily activities in order to try to preserve the health system and to have not too many people die too suddenly from the spread of the disease. So as a consequence of that, in the United States, there was a fairly massive reduction in employment, which bounced back pretty much halfway, or actually much more than halfway, which is bounced back pretty much last quarter. And I'll say what bounce back means in a minute, because what happened was there was a 30% drop in GDP and then a 30% increase in GDP, but a 30% drop from 100 and then an increase from a 30% increase on 70 means we're still not back to where we were, and nor are we likely to be. So as a consequence of asking many of our fellow citizens to stop working for the benefit of all of us, I think we have a social obligation to help those people to preserve their lifestyles, to be able to keep paying for rents, to keep paying for food. And that's essentially what most Western countries did. We had a massive increase in transfers to people who had been laid off and were unemployed. And that's a good thing. We're now at a situation where we've come back quite a long way, but there are some changes ahead that I think are going to be permanent. So moving forward, the adjustments that we're going to be seeing in the next 6 months to a year are going to be adjustments that were caused partly by COVID, but were also trends that were in place before COVID. So an example of that, I think we're going to be seeing a lot less people working in center cities in offices, a lot more people. So the move to production of services that can be done remotely, that I think will be accelerated. I strongly suspect that airline travel is not going to be coming back to the level it was. We already saw a fairly big move towards the long distance interaction in meetings, and that I think will continue. So the answer is yes, we can spend our way out of COVID in the sense that by providing government assistance to people who were unemployed and helping them get back to work. We've done a lot of that already. We both can and should do that. So the answer to that question for me is yes, and I will be coming back and saying more about that in a minute. That takes me to question 2. Might we slip into a bad equilibrium? And the answer again very much is yes. With government programs like the one that we've just seen, massive increases in government debt and transfer payments. Big spending programs like that, particularly when they're financed by money, and I think in this case they should be, are a bit like putting the government on crack cocaine. It's very easy to get into a situation where we fund good things by printing money or by borrowing, but it's a lot harder to get out of that situation. And I'm going to come back to that in a few slides after I discuss what it means to be in a bad equilibrium, when I talk about the difference between fiscal and monetary policy. And basically my point there is going to be that fiscal policies are related to flows and monetary policies are related to stocks. So I'll get to that point in a minute. Before I can even answer this question, what does it mean, could we slip into a bad equilibrium? I want to say a little bit about equilibrium notions as an economic theorist. There was a tendency, I think, to think about equilibrium economics as the intersection of a demand curve and a supply curve. We've moved a long way beyond that idea. And the equilibrium in models I look at are more like the equilibrium in a gas. So if you think about the gas laws, we know that the atoms in a gas or the molecules in a gas are always in motion. And the concept of equilibrium would be much more closely related to, well, we could measure the temperature of the gas, the pressure in the gas, and if the temperature and the pressure remain constant for some number of periods, we might say that gas is in equilibrium. And that's very much the way that economists look now, at least the ones I talk to in thinking about economies. So the way we think about equilibrium goes back to John Hicks, who introduced a notion called temporary equilibrium in Value and Capital. What Hicks asked to think about is the economy really taking place in a sequence of weeks. And each week people meet and trade, and they bring contracts with them negotiated from previous weeks. They form expectations about what they will think and what will happen in future weeks. And there's some process each week which leads to a situation that economists would call an equilibrium. Now, there are many ways of thinking about how to formulate that idea. And that's really, I think, how you think about an equilibrium is at the cutting edge of the differences between modern conventional economists and post-Keynesians. My view is that the equilibrium concept that we should be thinking about very much leads to the possibility of multiple things being able to happen in any given week. all of which could potentially be in equilibrium, and all of which could be potentially influenced by not only by government, but also by psychology. So I have a line here that says, Keynes told us that when unemployment is high, governments can kickstart the economy by borrowing and using the funds to employ people. And I think that idea is right. So I'd like to show you the differences between conventional views of the economy and what I think are correct views of the economy. So it'll help me to try to talk about the situation we're in and to the kind of things that we might mean when we say we got into a bad equilibrium. So I've drawn a picture here, which is to try to help me think about what a shock like COVID-19 might have done. And the picture, the top picture is showing you a measure of economic activity, the unemployment rate in a fictional economy over time. And the bottom picture is showing you what would be happening to GDP per person, another measure of economic activity over time. And there's a date that I've called date zero at which something happens. And that's something I'm going to think of as the COVID-19 shock or the financial crisis. It's a big shock. It causes some unemployment. After the shock, unemployment goes up a little bit, but eventually, sometime later, maybe a year, maybe 5 years, well, that's a property of the economy, the unemployment rate returns to what conventional economists would call the natural rate of unemployment. And GDP, under this scenario, takes a hit because people are laid off. It moves down a little bit further, but eventually GDP comes back and gets back to the same growth path that it would have been on in the absence of the shock. That, I would say, is pretty much a conventional view that many macroeconomists share about the way that a modern Western macro market economy functions. I think that view is completely wrong. And here's what I think is a much better way of thinking about what happens. I've called it a theory that involves multiple equilibria, but the basic idea here is that shocks to demand, and what would I mean by a shock to demand? Well, one example of a shock to demand would be a big increase in government purchases that happened only once. It could also be a monetary intervention by the central bank. And what seems to occur in the recessions we've observed is that shocks, which are obviously demand shocks, and an example of that would be the great financial crisis, do lead unemployment to move above the level it was previously at. But following the shock, there's no tendency to return to the same natural rate of unemployment. And concomitant with that, the path of GDP that the economy might have been on before the shock shows no tendency to return to the same original growth path. So that's a second view of how economies operate. And it's one that I've spent a great deal of time thinking about how to model formally. And you might say, well, which one of those is correct? And this is a picture that I took from my book, Prosperity for All. I had a line in some previous talks I gave. I don't think I have that slide here. There's an aphorism in America. If it looks like a duck, walks like a duck, and quacks like a duck, it probably is a duck. And what I mean by that is that the evidence this is from the Great Recession, from the financial crisis, suggests that this view of what happened is a better description than this one. Here's some more evidence for the same thing. So what I'm showing you here is that after every recession this is United States data from post-war period from 1948 up through 2015. I've not had time to update this. The gray bars, the gray shaded lines are recessions in the United States. And you'll see in every recession, there's a very sharp increase in the unemployment rate. In recoveries, there's a much slower reduction in unemployment. And what the red bars are showing you are the average unemployment rate in the recovery following each recession. And I think that's a good visual representation of the properties of the unemployment rate in data, which is that it shows no tendency to return to some natural rate. And for me, that's an indication that the Keynesian idea, important Keynesian idea, the central idea for me in Keynesian economics was that that there are essentially many potential unemployment rates that the economy could get stuck in some sense. And there is a role as a consequence of that for government to, in my view, design institutions to try to generate good private outcomes. So that's my answer to can we spend our way out of a recession? And not only can we should spend our way out of a recession, in my view. But, and here's a big but, we need to be very careful. So there are some episodes that I could point to where a big fiscal stimulus has been successful. So one of those is we had a decade of unemployment that never dropped below 15% in the 1930s in the United States. There was a massive fiscal expansion in World War II. Many economists at the time were worried that the economy would slip back into another big recession. That did not happen. So that appears to have been an example of a big fiscal stimulus that was in some sense successful. Purely from the economic point of view, I'm not suggesting that a large world war is a successful episode in any sense, but from the economic point of view, the fiscal stimulus appears to have sort of jolted the economy out of the recession. But I would notice that the increase in the size of government after that episode was permanent. There have been other episodes of big fiscal stimuluses that have been spectacular failures, and there I would point to many Latin American hyperinflations. So there are many episodes of governments that have tried to spend their way into prosperity, and the consequence has been spectacular increases in unemployment and inflations that have been very difficult to eliminate. I think I have about 5 or 10 minutes. So I'd like to talk a little bit about the difference between monetary and fiscal policy. And this is my definition, because the definitions in the literature are sparse in some sense. So fiscal policy is a flow. So governments choose each year, each quarter, how much to spend. They set tax rates. And if the amount they want to spend is different from the revenues they're raising in taxes, the balance is paid for either by issuing money, printing money, or by borrowing. And borrowing, government borrowing and money are essentially the same thing. They're simply, they are government liabilities denominated in I'll call them dollars. I've lived in America so long that I can't say anything else anymore. So they are dollar liabilities of government. And fiscal policy is all about how much to spend each period and how much to tax. Monetary policy historically has set the composition of government liabilities between interest-bearing and non-interest-bearing components. And it's a stock policy. Now, monetary policy in recent years has ventured into a different area. It's ventured into situations where governments have been, central banks in particular, have been taking much riskier positions in the asset composition of their portfolios. And once you start wandering into that area, the boundary between fiscal and monetary policy becomes very blurred. So let me explain what I mean by that. Traditionally, a central bank would be on its asset side, it would be holding the liabilities of the treasury, of the government. On its liabilities side, it would have the stock of money. And as a consequence of the fact that the government was paying interest on its on bonds, the central bank would make seigniorage revenues, and those seigniorage revenues would be returned, they are returned, to the treasury. Now, that's not the only kind of policy that central banks could engage in, and recently they've been holding much riskier kinds of portfolios. In the great financial crisis, the Fed in the United States purchased mortgage-backed securities. Central banks are buying private bonds. In many Asian economies, the central banks are intervening in the equity markets. And as a consequence of doing that, central banks can potentially both not only make money from the fact that the interest stream on their asset portfolio is greater than the liabilities they hold, they can also lose money. And as a consequence, there's a blurring between the stock policy of central banks and the flow policy of deficits. And as a consequence of that, let me back up a little bit. I've been a big advocate of central banks doing that, but there's a warning here, because as a consequence of doing that, central banks are wading into a very big political area. Now, I think, well, here's a picture. I didn't realize I had this picture. So here's for me the difference between fiscal and monetary policy. So fiscal policy is setting it's like a flow of water into a tank. Taxes is like a flow of water out of a tank, and debt is what's in the middle. So this is an interesting picture, because if you turn up government purchases or transfers to the public, and you don't recover the money in taxes, what will happen is this pile of debt will start increasing. And there will be a level at some point in time when debt becomes unsustainable. And that's essentially what was happening in Latin American hyperinflations. Okay, so I think I have, how much time do I have left?
Roger, I think it's the end of your time at the moment. It's 4:30.
Okay, so give me just one minute to finish up. I think this is probably my last slide. So I'd stress monetary policy is straying to the realm of fiscal policy, financial policy, and I have reasons that I hope I can get to into the discussion as to why I think financial policy is a useful one to follow moving forward, is fiscal policy. And by that I mean much riskier composition of central bank assets. And I want to stress these last 2 points, because if we are going to give a larger role to central banks moving forward, we also need to be very careful about the political controls we put on central banks. I see a role for banks. the people who are operating central banks need to be disciplined very heavily by the electorate, because the consequences of the actions they take are not only fiscal, they're also distributional in very big ways. And I'm sure that some of the other people will get to that. So that's my final slide. And I hope you'll go out and buy my book.
That's great. Thank you very much, Raja. Thanks a lot. So at the moment is 16:32. So we have 3 more minutes until, let me see here. Yeah, the break is 5 minutes, but we can actually start exactly at the same time. So after that is Fazil. Is that possible to start at 16:35? Yeah, is that correct?
Absolutely.
Fantastic. So we have about 3 minutes break, and after that in 16:35 we can have Fazil. Thank you.
Guys, I'm going to have to restart my computer. It's acting up on me. I hope I can do that right now. Thank you.
Okay, thank you very much, Fazil. So we have the same kind of question about the sustainability of debt, and also about the monetary policy, if it can stimulate the economic activities. So I just leave it to you. Thank you.
Okay, thank you. Thank you again for the invitation, for including me on this this panel. It's a pleasure to be here. I want to maybe you know, change what I plan to present based on what I heard from Roger. So I was planning to, you know, present, you know, the MMT answer to those questions from a U.S. perspective, but I think we'll have plenty of opportunities to discuss this. So I'm gonna bring the developing countries perspective to the conversation. So the question is, can we spend our way out of the COVID crisis? It depends on who's the we. We, as in the United States, the UK, you know, Eurozone countries, or developing countries. So let me start by saying that that we will determine, you know, which country has what level of fiscal policy space or spending capacity. So let's think of a spectrum of monetary sovereignty, with different countries having different degrees of monetary sovereignty. And as a result, different countries having different levels of spending capacity to respond to this crisis or any other crises to address unemployment, to address climate change, socioeconomic exclusion, and so on. What determines that degree of monetary sovereignty? Monetary sovereignty is not something that you can legislate. It's not something that you can declare publicly. It's something that you earn through hard work and through structural policies that you introduce. In other words, the degree of monetary sovereignty can be increased over time. And you can also put in place the wrong policies and lose monetary sovereignty. So from a developing country perspective, let's think of it this way. The mainstream approach tells us that the fiscal policy space is limited or constrained by tax revenues and borrowing capacity. And we're told this is as much as we can do. It's too bad. There's a lot of priorities. We have to, live within our means. What MMT is saying is that that spending capacity or fiscal policy space is actually usually much larger than that. It's not unlimited. It is constrained, and it's constrained by the risk of inflation. So the question becomes, what determines that risk of inflation? And a little footnote here about the mainstream approach to inflation. I think the mainstream of the profession is reaching a dead end on this question. And I think it's been recognized by many central bankers and people in the profession that the traditional theory of inflation is not reliable when it comes to what's been happening in the world of central banking in the last 12 years at least. So what determines that risk of inflation? To me, it's two things. One is the shortage of productive capacity. So if we run out of physical productive resources, skilled people, technology resources, and we keep spending, then we'll see prices going up. The good news about that is that productive capacity is producible. We can invest in building more hospitals, training more doctors and engineers and so on. And that creates millions of jobs. So that means strategic spending, strategic investments in key areas. That includes industrial policy, that includes agricultural policy, that includes investing in research and development and education and technical training. So we can increase the productive capacity, and as a result, we push away that inflation constraint on the production side. The second source of inflation to me, which is relevant both in the case of the US, I guess, and especially in developing countries, is market power. So you have key players in particular industries who can raise prices simply because they can, because they have too much market power. And that kind of risk of inflation is not going to go away via austerity. It's not going to go away by spending less. It can only go away by taxing and regulating their market power out of existence, by making those markets more competitive, by democratizing economic activity. So that means lawmakers have a key role to play, and we call them lawmakers because they make the laws, right? But if those lawmakers who are supposed to be in charge of regulating that market power are bought and sold via super PAC campaign contributions or other corrupt practices, then we have a problem, because that means that that market power is suffocating the potential fiscal policy space that could be available to us, right? And so the more you democratize, the more you can potentially increase that fiscal policy space. Now, to zoom in on the particular case of developing countries, the constraints are much more severe, obviously, than in the case of the US or the UK or Japan. When you look at the debt sustainability question, which we have on the table here, we usually think of debt as one block, but it does matter whether your debt is denominated in your national currency versus external debt denominated in dollars, euros, and pounds and yen. So for developing countries. So if you think of what I call domestic debt denominated in your national currency, that is usually easier to manage. And we can have a conversation about how we do that. It's the external debt constraint that creates a real financial burden on developing countries. So when you look at most developing countries, historically, that level has been rising consistently, and it's the constant austerity pressure point for most developing countries. So you dig deeper into the source of that debt. And why do these countries continue, despite all efforts to modernize, industrialize, diversify, all of that? Why do they continuously, fall into this deeper and deeper trap? And it turns out for most developing countries, there's three structural sources. One is massive reliance on food imports. So the lack of food sovereignty, let's call it. Massive reliance on energy imports, let's call it lack of energy sovereignty. Then the third one, which is the more complicated one, which is a structural situation where you have low value added content of exports relative to high value added content of imports. So the faster you try to accelerate your exports via quote unquote industrialization, the deeper you fall into that trap, because you import the technology, you import the intermediate goods, you import the fossil fuels to run the factories, you import more fossil fuels and more food to bring millions of tourists because you're trying to accelerate tourism. So all of these, standard solutions lead you further into that trap. So how do you get out of that trap structurally? Is you start investing in more food sustainability, more food sovereignty. You start investing in renewable domestic energy production. You start investing in education, vocational training, infrastructure, so that you start becoming more selective in the industries that you actually specialize in and the foreign direct investment that you bring to the country, so that you climb that ladder, so to speak, over time towards higher and higher value added content of production. But instead, the mainstream policies that we've been pursuing for decades, what's the prescription? Bring more tourism, right? Bring more foreign direct investment, anything, race to the bottom, right? Lower labor standards, lower environmental standards. Try to accelerate your exports. And manufacturing, it's essentially cheap assembly line type of manufacturing. So all of these solutions are traps at the end of the day. So what happens is you reach a situation where you're constantly accumulating more external debt. And if you slow down the acquisition of more external debt, you're facing a currency depreciation. A currency depreciation means the next morning, if your country is going to import medicine or food or any essentials, you're importing them at a higher, you're importing inflation essentially to your local economy. So you're setting yourself up politically, socially for food riots the next day, for political unrest and social unrest. So in order to protect or insulate your economy from those political and social risks, what do? You accumulate more external debt. And now the external lenders are telling you, well, pursue the same policies. Why don't you try harder next time? Bring even more tourism, bring in more foreign direct investment. And then the trap keeps going. The more tourists you bring, the more food you have to import, the more fossil fuels you have to import to transport them and heat and cool the hotels for them and so on. So we need to, as we say, if you're in a big hole, the first thing you do is you stop digging. You don't dig faster, right? And you design strategies to get out of that trap. So this is where the conversation needs to go in the case of developing countries. It's not about spending more. It's about what are you spending on? Are you spending on feeding the tourism industry so that you build more hotels to import more fossil fuels, to import more food for a tourism industry that's dragging you down economically and ecologically? Or are you spending strategically to increase productive capacity in areas that allow your economy to build that resilience in the food sector, in the energy sector, in the public health sector, and strategic industrial sectors? Because not everybody needs to produce everything, right? Where do you spend the money to build the productive capacity, engineering and technical and vocational skills that you need for strategic areas, so that you get to a point where you can actually absorb external shocks without having to face protest for people starving on the streets, which is what we've seen frequently, right, in developing countries. So the MMT lens is really not, saying that spending is limited in this country or that country. It's saying it all depends on which country you're talking about, what are the areas of lack of resilience, and how can you mitigate those risks. So now to bring this full circle into the inflation constraint in the case of developing countries, and we can have conversation about the US and other countries, that becomes then a serious political question and a democratic process question. Because let's say now we have well-informed MPs, citizenries, and farmers movement that says, you know what, we want to build better food resilience. We want to invest in sustainable agriculture. We want to invest in sustainable renewable energy and so on. Let's dedicate some resources to that to we build that kind of resilience. Well, now you have, in most developing countries, exclusive import licenses that are handed out to key individuals who are in charge of importing rice for the country, or fossil fuels, gasoline for the country, or milk or eggs or whatever it is that the country needs, because these are very sensitive areas that are usually handed out to individuals. And when I speak to different people in different countries, they can usually name who those individuals are because they tend to be very famous business people, very powerful. In some cases, they tend to be cousins or related individuals to MPs or presidents, right? So now, if I'm that individual and I have the exclusive import license for wheat or corn or rice for the whole country, and I have a pretty significant price setting capability in that system, now why would I want to lose that privilege, right? If I'm the only one importing gasoline for the country, why would I want to lose that privilege? Because you know what, when OPEC prices go up globally, I can raise my prices accordingly. But when OPEC prices go down, I don't really have to lower my prices accordingly because I have that exclusive market power. So these individuals accumulate massive economic and political power, and that leads us into the corruption in the system. So now I'm going to do whatever I can to fund academic research, PR messages, to convince everybody that this is a waste of time, that this is really putting the economy at risk. And that's the nice way to do it, kind of by just messaging and kind of bribing politicians. In some countries, this goes into actual violence or threat of violence against individuals at the grassroots level who are trying to actually to diversify the economy and build that resilience. So that kind of market power that I'm talking about is not going to go away with austerity. It goes away by democratizing the system, by democratizing the economy. So those are the real constraints that suffocate your fiscal policy space. And those are the real constraints that need to be tackled simultaneously. So it's not a one-dimensional or two-dimensional policy that we're talking about here. We're talking about multi-dimensional kind of comprehensive economic policy reform to release that suffocation that most developing countries suffer from, which means you have to have a democratic process, you have to have a clear vision and a clear understanding of what the constraints are, beyond the mainstream constraints of, we can't print money, quote unquote, we can't print money, it's going to cause hyperinflation. And then you have to have the political commitment and the social movements to demand this, better world, which I believe is within reach, but it can't be achieved if we're aiming in the wrong direction, if we're not aiming at the real constraints. And I mentioned here domestic constraints, let alone external constraints when it comes to corporate power, multinational corporate power and influence in smaller economies, developing economies. The last thing I want to say about inflation management, or inflation targeting, which is something that comes up frequently, and central bankers in developing countries are obsessed with the idea of inflation targeting. If you go back to what I explained earlier in terms of the sources of inflation for most developing countries being imported fuels and imported food and imported medicine and so on, if those are globally determined prices, so if OPEC determines your energy costs, what can you do domestically as a central banker to convince OPEC to do otherwise? If your source of inflation is wheat prices determined by the Ukraine or by Australia or by Russia, what can you as a central banker do to change their policy? There's nothing you can do to tame that source of inflation. So suffocating your domestic economy is not going to change pricing decision in the Ukraine or pricing decision in Russia or pricing decision in Saudi Arabia, right? So we have to, there's no way you can have true resilience if you can't control those variables. So if you transition to more domestic renewable energy production, more democratic, more decentralized, then you don't have to care about what Saudi Arabia does with oil prices because you're insulated. So you have to work hard to earn that resilience. It's not going to be declared by a central banker or by an MP or by a president. So I'll leave it at that, and I hope that this will raise interesting questions in the Q&A section. Thank you again.
Thank you very much. There is
we have more time. I didn't realize I have more time. I'm happy to answer questions right now. Or
there is one question actually. Salman asked you, which developing countries do you think are on the right track in terms of developing their monetary sovereignty?
It's a difficult question to say. I mean, the short answer is there is no perfect example, right? There are bits and pieces of hope here and there. So if you think of this last point that I made about inflation and inflation targeting, our intuition as economists is to look at what the central bank is doing, right? And say, well, how well are they managing the risk of inflation? What are they doing about it? But if you follow kind of the implication of what I just described, it turns out that the inflation, quote unquote, targeting policy is not really in the jurisdiction of central bankers. If the source of inflation is wheat prices, then it's an agricultural policy. It's the Ministry of Agriculture that has the capacity to mitigate the risk of inflation. It's not the central bankers. If the source of your inflation is energy prices, then it's really the Ministry of Energy, or hopefully renewable energy, that has the capacity to mitigate that risk. So it's a multi-pronged type of approach. And if I may finish, Indonesia is actually an interesting case where they do have that approach. In the last few years, they've developed sort of I forget what it's called, some sort of national commission of representatives from all of these different ministries who are actually thinking carefully about the risk of imported inflation and designing strategic policies to mitigate them outside of the central bank jurisdiction.
Can I throw in a question?
Yes, please.
So can you just say a little bit about what you think is the role of exchange rate regimes in this discussion? Because
right.
Even if your energy prices are going up in terms of US dollars, doesn't mean that that necessarily has to lead to domestic inflation.
Right. So I'm the last person to recommend to developing countries to move from fixed to flexible exchange rate overnight. It's everything I'm describing here is really, that's why I say it's something you earned. So the goal is, with higher degrees of monetary sovereignty, you can go towards a flexible exchange rate and be able to absorb external shocks without having to throw, your people under the bus, so to speak, in terms of food necessities and so on.
One more comment that's raised by what you said. So do you see a role then for presumably everything you're saying seems to suggest that you're not in favor of open capital markets here.
So
that you'd like. So, and I'm guessing that's a necessary concomitant of what you're saying, that you're talking about developing nationally rather than globally. So you're
right.
And I concur with a lot of that, but just trying to tease out.
Yeah. Capital controls is part of the toolbox of this multi-pronged set of policies, because you have to build in these guardrails and these protections to the system. And if you're giving, speculators, if you're letting speculators be in charge of your economy, then you've surrendered, right? And then they determine your economic policy, which is the system we have right now, which is why central bankers say we're going to have to raise interest rates to kill the source of inflation, which means we slow down the economy, we slow down domestic economic activity and credit expansion in productive areas, which means we're going to throw you under the bus to defend the exchange rate. And that's just not democratic, not socially or politically or economically sustainable. And we've tried it for 50 years, right? It's time to try something else.
Can I ask another question? We have about 4 minutes. Is public debt sustainability issue for developing economies who have managed the COVID-19 a lot better?
So can you say it again? I think I missed the first part of your question.
It's public debt sustainability issue for developing economies who have managed the COVID-19 a lot better.
Well, of course, if you've managed the public health side of the crisis better, it probably means that you've intervened early on and you intervened quickly, which means you can transition into reopening the economy with all the public health safety standards, which means you minimize the effect of the economic shutdown and you restore economic activity. So absolutely. The problem is many countries, thought they had things under control after the first wave, and then reopened too quickly and let down of the guardrails. Here, I'm thinking of my own home country in Tunisia, which is now facing a disastrous second wave, leading into another shutdown right now, happening in the last few days, with hospitals literally being overwhelmed. Now they're moving into outdoors tents as makeshift hospitals. And as a result, the impact of the second wave on the economy is going to be devastating.
That's great. Thank you very much, President. So at the moment it's 16:57 here. So we have 16:58 now. So we have 2 minutes. We start just 1 second. I have to check the timetable. So from 5 o'clock to 5:05, we have a break. And after that, George is talking about these questions. Okay, so we can have a little bit 2 minutes more break. Yeah, is that okay? So we come back at 17:05, 5:05. Thank you very much. Thanks a lot.
So Fadel?
Yeah.
So can we chat during the break?
Yeah, absolutely. I'm here.
I mean, I agree with many things you said. What do you see China as a model here? What do you think about how China evolved? Because that was not a nationalist; it was a globalist approach.
Right, but China was only able to move into this mode after building up its productive capacity, infrastructure. I mean, the reason why they attract the vast majority of FDI in the global South is not because they're the only country with cheap labor or relaxed standards. There's plenty of other countries that can do better on that front, better, quote unquote. But it's because they have the telecommunication infrastructure, the transportation infrastructure, all of the capabilities. And now China and India, they're also moving into the high value added content manufacturing. When I was a kid, the known fact was anything made in China was just cheap plastic, is going to go bad after 3 weeks, right?
And before that,
that's not the right, exactly. And today, my kids' generation, my students, they know made in China as the great stuff that we use, all the iPhones and all the stuff. So that didn't happen by accident.
I hear what you're saying, but China started out as a completely underdeveloped economy, and Nixon goes to China and opens up. Is that a feasible, whatever they did at that point, I'm asking, is that a feasible model for a smaller underdeveloped nation now, like Tunisia, for example? Or was there something about the period in history that means that window is now shut? Or I think the size of the economy?
Yeah, I think it's that window is definitely not open anymore. So you can't do the 1950s and 60s protectionist policies. Every country is locked into WTO agreements and all of that. So I'm definitely not in favor of protectionism in the 60s style. I'm in favor of strategic industrial policies that can help you gradually to build resilience. And China is not the best example for smaller developing countries. Better examples are Singapore or South Korea. And granted, they developed in a different era under different global, rules. But it doesn't mean we should give up. And go ahead, please, George.
Yeah, surely China's big takeoff wasn't the 50s or the 60s, but much later.
Yeah.
in the 80s.
Yeah, but they were still closed and protected. Yeah.
In some ways, of course, but they were also opening up in a lot of ways compared to the past.
Sure.
But
But the same takeoff that you see in India also, India's didn't take off prior to having the industrial capabilities, the telecommunication and infrastructure capabilities, not across the whole country, but at least in strategic areas that are now the booming industrial heart of India.
Yeah. I think there's an interesting tension between the climate change problem and industrialization of these countries, because you're seeing prime ministers of, I think it's, developing countries in Africa embracing the notion of developing energy resources at exactly the same time when the rest of the world is saying, no, you can't do that because you're going to destroy the planet.
Well, I'm going to drop in the chat box here a recent piece in which I sketch very briefly my vision for something like a global Green New Deal, which I argue can't happen without climate reparations and colonial reparations, with transfer of financial resources and technology to the global south.
Good luck on getting democracies in the West to vote on that one.
Well, exactly. Yeah. I'm saying I'm not naive in thinking that this is going to happen. But I'm saying, we can't, call for a better world unless we have at least a strategic vision and then work hard to bring the social and political movements in that direction.
Yeah.
Roger, sorry, there is one question for you. Can you do that in 2 minutes? A question for Professor Farmer. Is the case of EMU a permanent shock after GFC? And are they on different paths?
Hang on, what's the EMU? Oh, European Monetary Union. So, is that what they mean?
Perhaps, I'm not sure, because it's just EMU, European Monetary Union. Yeah.
So, what's the question? Is
the case of European Monetary Union a permanent shock after GFC, Great Financial Crisis, perhaps?
So they might be talking about Brexit, I'm not sure.
And are they on different path this time?
So is Europe on a different path? Is that the question? I'm too confused.
So I'm not sure exactly. It's from Muhammad Ali Nasir. Can you reword your question, Muhammad Ali, if it is possible, please? So we have just 1 minute. Okay, so we can actually start with George, and after that, I can ask you this question. Is that okay?
Yeah, let's leave that to the discussion.
Yeah, that's great. Thank you very much. Thanks a lot. Okay, George. Same questions, and I just leave it to you. Thank you.
Okay, thank you, Farzad. I was encouraged to talk a little bit about the difference between what's been happening now fiscally and otherwise and monetarily, and what went on during the Great Depression, in order to put a little bit of context on the scale of interventions today. So if you don't mind, I'm going to put on a few slides and go through those. I'm going to talk about what the government did back then and compare it to what it's done recently. I'm also then going to go on to discuss some of the question of whether the current policies are likely to be inflationary or not, or fiscally sustainable or not. It's actually impossible to completely separate those two issues. And that'll pretty much wrap it up. I'm going to make a couple remarks at the end about the question of market power versus aggregate demand as a source of persistent inflation as well, in response to some of the things Fadal said, because I want to push back just a little bit on that. So let me get my slideshow up if I can. And so I'm going to share my screen. Let me know if you're all seeing my slides now. Great. So people have been tempted to compare the recent crisis with the Great Depression. Of course, they compare every crisis with the Great Depression. The Great Depression is our standard against which we measure all the others. And it was tempting in this case because the crisis was a very sharp crisis as far as the downturn of activity was concerned. And it really was in some respects comparable to the Great Depression. But it's important, of course, to note that whereas the Great Depression was also great with respect to how long it lasted, it wasn't really over until World War II, and that's relevant to some later remarks I'm going to make. We've already witnessed, as Roger pointed out, a considerable recovery from the present crisis, at least so far as the standard measurements of unemployment and output are concerned. So let's hope this continues despite the new waves of corona outbreaks that we're seeing. But so far, at least, this depression isn't great in that respect as the Great Depression itself was. The first thing I want to note, I'm going to talk about fiscal policy first, is that although we think of the New Deal as having been a period of really aggressive fiscal stimulus, while that may have been true to some extent with respect to earlier times, it's certainly not true in comparison to the kind of fiscal activity we see today. This chart shows the amount of the change in spending, that's the real government spending, that's the red line, and deficits, which is the blue line. And also receipts are there in the middle in green, compared to the change in real GNP. So this is as a percentage of the change of relative to the percentage of the decline in real GNP, not to just total GNP. Fiscal policy and government spending itself were very, really quite modest by today's standards, and never seeing deficits approaching much more than about minus 10% of GDP, or rather 10% of GDP. And for this reason, the fiscal contribution to the recovery from the Great Depression until World War II was actually very, very modest, as a number of scholars have pointed out. In comparison, if we just, this is just to elaborate a little bit more, this chart shows the deficits in blue and the amount of expenditures in green. And as you can see here, first of all, there's not that much difference between Hoover and FDR in the beginning. And that's partly because both of them were trying to balance the budget. The deficits that did emerge were despite these efforts to, through new taxes and austerity, I should say, to try to keep the budgets in balance. Of course, as the Depression worsened, the deficit spending became somewhat greater. But until after 1937, there wasn't, the New Deal had not really embraced the idea of deficit spending. After 37, it did. And this one big blip you see in 36, this was something called the bonus bill for the Army, which Congress passed, but over the administration's veto, over FDR's veto. That was the one time. And now here, I just want to put this in perspective. I don't know where your pictures are, but this shows the deficit. Here you can see at the beginning of this chart just how big the World War II deficit was compared to anything in the 30s. And that turns out to be relevant because although this chart doesn't go up through 2020, in fact, if it did, you'd see that the level of deficit spending and of government spending generally in response to the current crisis is actually more on the scale or in the order of magnitude of the World War II level than of the New Deal level. So it's pretty significant. Here we see a chart that does refer to today, and you can see the huge and rather sudden spike in government outlays in response to the crisis, fiscal outlays. And there you see that number there, that peak at about 33, 30, it's I think about 33%. And again, we're comparing that to 44-ish% in World War II. So we have learned something from the New Deal, but what we've learned is to do a lot more actually than the New Deal did. Perhaps, again, something more on the scale of World War II. And the next chart also shows in more detail some projected changes. And here, I should say that that spike, I think you all know this, is mostly, a large part of it is unemployment compensation, which of course didn't exist during the New Deal and now exists and automatically kicks in a crisis like the present one. Plus our government supplemented the usual unemployment compensation. So there was a lot more of it. Now, of course, it's only a spike because we haven't had a second round of fiscal stimulus or aid relief, a second relief bill passed. So it's according to the developments in politics so far, that spike is it. But we may see another one if the new Congress is able to put together a package. But the other thing this chart shows is that going forward beyond the crisis, we're going to have a lot of interest expenses that are going to be part of the budget. And of course, and that's the one line that slopes up the most in the long run. And that's some indication of the projected future fiscal burden, partly as a result of the additional debt that's been taken on recently. And of course, the slope of that line will very much depend on how much interest rates go up in the future and how soon they go up. So that's something to keep in mind when we talk about later on about the debt burden or the interest burden and the likelihood of inflation and all that. This chart shows that that all of these fiscal measures have contributed. Perhaps they're not the only thing contributing. There's monetary measures too that I'll get to. But what we've seen is a recovery of spending, total spending, that is not quite complete. And of course, it's misleading to think just about the recovery of spending. We have a gap that we have to build up, as well as a recovery of the growth rate of spending, which is what we see here. And even the growth rate of spending, last time they measured it was still short of, in the last quarter, was still short of where it used to be before the downturn. So nothing like the 1930s, where it took forever for spending to revive. Turning to monetary policy, once again, it's important to recognize how little the Fed did back in the 30s compared to today. And that's most visible here if you look at the purple line. That shows the bills and securities held by the reserve banks. Roughly speaking, you can think of that as giving you a sense of the open market activities of the Fed. And compared to the other lines, which I'll refer to in a moment, it's pretty flat. And indeed, it gets almost completely flat sometime around the middle of 1934. There's just not much going on. Certainly no aggressive open market purchases. Now, what the other lines show is, green line is for the gold stock, and the red line is for total gold reserves. And that green line jumps up because of the devaluation of the dollar, which automatically increases by a factor equal to the devaluation, the total gold reserves. The red, though, shows, the total gold stock. The red shows the gold reserves, and notice it doesn't jump because the Treasury grabs all the profit from the devaluation, so the banks don't get it. But it does go up, and that's mostly gold imports from abroad. So what's driving the recovery more than anything from the monetary point of view, and the fiscal contribution, fiscal policy is small, is gold imports from abroad. And ironically, it's mostly because of jitters about Hitler and the rumors of war in Europe that's driving that. I'll just say very quickly that interest rates were very low then as they are now. So you had the same argument for quantitative easing in principle that we have today, but nobody made the argument back then. Instead, they said it's futile for the Fed to expand its balance sheet. It's like pushing on a string. The banks are just going to accumulate excess reserves, and that's not going to do anything. Today, QE gives us theories that say, well, it could do something if you do enough of it. And that's a big change, of course. And here, of course, you see the balance sheet recently, which increased fourfold with the 2008 crisis. And in a very short time recently, your faces are covering up that part of my chart. I don't know where they occur on your screens, but very recently it's gone up by almost a doubling. It's gone up by about $3 trillion in just a few months, which is really something even compared to the period past 2008. I'm going to skip a couple of slides here and move on to talk very quickly about credit policy. And there again, the Fed was not very active. Here you see the total reserves of the banking system in the 30s going up, mostly because of gold. And there you see at the bottom in blue changes in the Fed's bill buying, which is its lending activity as opposed to its bond purchases or open market activity. And there's just not much going on. One aspect of Fed credit policy that is kind of interesting, I don't have time to talk about it a lot, is that they created a Main Street lending program similar to the one we have today. But it was quite a disappointment. These figures suggest that there was not a lot of lending that went on under this program, and they finally gave it up, but not till after World War II. And in that respect, it somewhat resembles today's Main Street lending program in being somewhat disappointing. I don't have a lot of time left, so I'm going to jump right to the question of inflation. Obviously, the magnitudes of fiscal and monetary stimulus, to call them that we've seen, I've tried to suggest this is a very, very aggressive response. Yes, it's disappointing to a lot of people who think there should be even more, but it is still in the order of magnitude of this, closer to what we saw in World War II than anything during the New Deal. And that, of course, has raised the question of inflation, especially given the massive growth of the Fed's balance sheet that has taken place, combined with the growth of the government's debt. And I should point out, since we're making comparisons with the 30s, that it was this fear of inflation that got Fed officials in the Treasury around 1936 to start worrying that their bank's excess reserves were about to be unleashed and cause a lot of inflation. So they doubled reserve requirements and sterilized gold inflows, and that probably precipitated the recession of 1937-38. I don't think we're going to do anything like that. People today, for the most part, aren't worried about inflation, but some are. And this is one of several headlines that you could find in the press of people saying, we're bound to have a lot of inflation eventually as a result of the current policies. There's a bit of a boy who cried wolf syndrome going on here, because we heard the same kind of talk after 2008. And of course, it never materialized into inflation. As you all know, the Fed persistently ran short of its inflation target after 2008. And indeed, it's still running short today. If we look at sorry, let me jump ahead. If we look at inflation forecasts, this is the 10-year inflation break-even rate. And the last time I looked, it was 1.7%. And that means that the bond market, which is not silly about these things, isn't expecting inflation to hit the 2% target for another decade, despite everything that's happened now. One reason for this is that with our system with the low interest rates that prevail, the amount of money injected into the banking system and added to bank reserves, shown by the blue line, has not led to any corresponding growth in broader money, including M2. it has grown rapidly, M2, for the short period of time. If you translated it into an annual growth rate, it's about over 20% growth, which is pretty scary sounding. But if we compare it to the overall growth in reserves, it seems small. And we have an offsetting dramatic decline in the velocity of money, which is why total spending is still short of where it was before the crisis. Now, that's the short run picture. I'd like to talk a little bit about the long run in the couple minutes I have left. Obviously, one thing that's not true about the long run is that the Fed has to worry that its balance sheet is so big that it won't be able to control inflation by contracting it again, which is difficult to do. But under the new system, operating system that the Fed has, it's not necessary for it to shrink its balance sheets to guard against an outbreak of inflation. It suffices for it to start raising the interest rate it pays on reserves, which is its new tool for controlling inflation. And in that way, it can contain inflation, even if banks try to rid themselves of excess reserves by lending and building up deposits more aggressively. But it's also true that the interest burden on the debt's going to grow a lot. So eventually, one of two things is going to happen. One possibility is that the Fed does indeed raise the interest rate on reserves sufficiently to contain inflation, even as spending revives and banks make more use of the reserves they have available to them. That's one possibility, and in that case, you won't have any dramatic increase in inflation. However, the more the Fed allows interest rates to increase in an effort to check inflation, the steeper that interest rate expenditure line schedule is going to look like, which means that the government is going to face higher costs of servicing its debt. And that's going to mean that the government is not going to like those interest rate increases. And neither will the public, because they do involve some, what they do essentially is to check private spending and investment. Now, what some people worry about, therefore, I think who've thought about these issues more carefully, isn't any immediate pending breakout of inflation, but the possibility of some greater fiscal dominance in the future, where the Fed is under pressure not to raise interest rates to check inflation. And as a result, we end up at last with inflation exceeding target. It's possible, and it's not something we should not worry about. Now, my last thing, I know I'm out of time, but I did want to say something in response to Fidal's market power argument about inflation, because it worries me. I think it would be a mistake to assume, a very serious mistake to assume that if we start seeing inflation rise sometime in the future, perhaps more than a decade to go by current expectations, market expectations, I think it would be a terrible mistake to write that off to market power rather than to demand growth. Of course, we can look at statistics and see what's happening to spending, and GDP would be the statistic I would suggest. But even monopolies have their profit maximizing prices, which are conditioned on the stated demand. So there's no theory that says that the profit maximizing price of a bunch of monopolies goes that they would want to, that there's no theory that suggests they would raise the price of their products year after year after year, which is what inflation requires, unless the market clearing, the profit maximizing, price is itself increasing. There's no reason why that should be true unless underlying conditions of supply and demand are driving the increase. So if we see inflation in the future, yes, we could very well say that it's monopolists raising their price, but we can't just say that. We have to ask why their profit maximizing price is rising. And that's going to ultimately, I think, suggest that demand growth is what we should be concerned about, and that the appropriate policies consist not just of dealing with the monopolies, but of checking the demand growth. So we won't be able to get out of that. So that's all I really have to say about these issues. And I probably said a few minutes too much, so I apologize for that. Thanks.
Thank you very much, George. Thanks a lot. In fact, you have 4 more minutes.
I do.
Yes. Do you want to talk?
I'll only say one other thing, because having made a little pushback against Fidel, I really owe him something on the other side of the ledger. So allow me to say that none of this should, none of my point about being alert to the role of excessive spending in driving inflation, even as we recognize that monopolies are part of what's happening. That's not to say that we shouldn't be diligent to distinguish between supply-related inflation, adverse supply-related inflation, and demand growth inflation. Of course, it can be true, and I'm sure it's much more important for developing countries than for the US, where you can have circumstances, like the COVID crisis for that matter, where adverse supply developments drive upward movements in prices. I'm not suggesting that central banks or fiscal authorities should try to combat those upward movements in prices through austerity or monetary tightening. I've long been an advocate of allowing adverse supply developments to be reflected in higher prices. It's the stability of the spending level and growth rate. Those should be the concerns of fiscal and monetary authorities, not higher prices per se. And with that, I think I'll yield whatever time I still have left.
That's great. You still have about 2 minutes.
I yield it for question and questions and answers and other discussion.
I will, if I may, since we have 2 minutes, I'll take the 2 minutes just to unpack one idea, not necessarily engage in further debate. We have another hour later for conversation. When the inflation concept that us economists talk about is very different than the inflation concept that my neighbors understand, which is why a lot of my neighbors are confused. They're saying, why does the central bank want to target a higher inflation rate than this, right? So if you unpack the CPI and you look at what's driving inflation, say in the US, it's clearly the healthcare industry. It's clearly housing and energy and transportation. All of these things are inflating at a high rate year to year, right? And that's not because there's too much access to healthcare. It's precisely because we're excluding people from healthcare, and it's precisely because health insurance companies and pharmaceutical companies have market power to raise prices because we let them, right? Because of the super PAC power. So this is really the part that I care about the most. In the context of developing countries, it's not even measured in the CPI, the equivalent of CPI index, because you have cross-border trafficking, because you have informal networks of food distributors who have that price setting capability, which affects cost of living and so on. So that's why you hear central bankers saying, or economists and the mainstream in particular saying, well, if you increase fiscal spending on employment, you're going to give people money, they're going to buy more food. That's going to cause inflation.
I want to throw in a line there, which is that as economists, we distinguish between a jump in the price level and inflation. And and again, my neighbors don't understand that either. But in a situation where we've just laid off half the economy, and then in order to help the people that we've laid off, we've generated a massive monetary transfer to them, you would hope there would be an increase in the price level in order to distribute the supply of food and basic goods out there amongst the people that are now bidding for it. But what you do not want is for that increase to then feed in to a permanent increase in inflation. So that's one of the differences I was trying to make between stocks and flows.
This is the reason why I say the focus should be on spending and its stability, because what we've wanted lately and what we've largely achieved is a revival of spending, which took a severe nosedive. And that was so in the 1930s as well. It's not the increase in prices per se. to be even more economisty about it, we want to see the equilibrium price level get back up, but we don't want the actual price level to get back up. And that's a subtle distinction that's always lost sight of. The equilibrium price level has fallen, or had fallen some months ago very much. That is, there would have been market clearing without as much spending if prices could have fallen equivalently, but that's not a good outcome. So we want the equilibrium price level to be where in fact it has been, but had been in the past, but is no longer. But nobody wants to see hospital bills, et cetera, going up in real terms, which is important. The problem I have with the market power hypothesis gets back to levels versus growth rates. If we go from a world of competing firms to a world of monopoly, we would expect a one-time jump in prices as the monopoly price displaces the competitive price. And now firms are profit maximizing at this higher price, lower output equilibrium. That won't explain why they should charge a still higher price next year, unless something has changed the market profit maximizing price level for the monopolist. So you can talk about monopoly power resulting in higher prices than competition, sure. What you can't easily argue is that monopoly power by itself explains why prices go up year after year after year, unless the monopoly power is increasing itself year after year after year. That could be, but it requires some argument to, in fact, demonstrate that that's the case.
That's great. Thank you very much. We have just 2 minutes to starting Eric to talk about his views. So just 2 minutes, okay? After that, we can hear Eric. Yeah.
2-minute break, you mean?
2 minutes break. Yeah. That's great. Thank you.
So for that, it's 25 minutes, right?
Yes, 25 minutes. So your time is from 5:35 to 6 o'clock in based on London time. Yeah. Okay, Eric. Thank you very much. So we have the same question, and we want to know your view about those questions. Can you please start?
Should I start now or should we wait for Badel and Roger?
I think Fazal and Roger are coming very quickly. Oh, just maybe 1 or 2 seconds. Maybe they have joined. Fazal, are you available now? Oh, we have Roger now.
Farzad, could you please repeat the questions again?
Yeah, of course. There should be here. So very generally, we are talking about the sustainability of debt. For example, to what extent do you think the government have the capability of printing or borrowing? How does this capability differ between countries which have so-called sovereign currencies and those which do not? And also, we have this question, can monetary policy stimulate economic activities? So at the moment, we have just these two general questions. We have a little bit sub questions as well, but we want to keep these two as general questions to hear the view of our speakers. Thank you. Eric, would you like to start?
Okay, sure. Yeah. Well, thank you for having me. And so what I'm going to do is try to answer the questions that were posed by first setting up the context of how I will answer them, and throughout this presentation give you an idea of where I stand on them. And so what I want to look at here is the idea of monetary sovereignty, something that Fadel touched on, but go a bit deeper, looking at what it is, how it's implemented, and the implication in relation to the questions that are posed in this panel. And so first, what are the main characteristics of a monetarily sovereign government? Okay, so it sets and enforces monetary laws. Okay, it tells you what it means to pay your debt. It sets the unit of account. It determines what the rules of the payment systems are. Then it issues an unconvertible national currency, not convertible into a foreign currency, not convertible into gold or anything else. It issues public debt denominated in that currency. And so that means that it's quite easy for that type of government to pay or service the debt. And it taxes in the national currency too. Okay, so those are four characteristics of a monetary sovereignty. Now, some governments are closer to that than others. Okay, some governments do issue national currency denominated public debt, but they also issue foreign denominated debt. Okay, and the higher the proportion of foreign denominated debt, well, the lower your monetary sovereignty. Monetary sovereignty emerged a long time ago, okay, at least 5,000 years ago. That's the historical record for the moment. And the aim was to move resources to the government, okay, move labor time, land products to the government, which at that time was a religious authority. And it's usually tax driven, okay, meaning that you have a power relation that is put in place. So it's not emerging from a trial and error in a market. You have a government behind imposing its will on the population. And it's done by imposing a debt or dues to be paid in the national currency. And so you create a tax liability. Again, tax here is a broad term to encompass all these dues. And the sovereign promises that in the future, the population can repay that debt by using the national currency. Then the second step is, once you have imposed a debt, you need to enforce the payment. And the enforcement of the payment of that debt is done by redeeming the national currency. So that's the tax payment part. And there are negative consequences for those, of course, who do not pay. That varied through time. Today it's prison, but you could have death or fines or anything like that. Okay, and if you look throughout time, okay, again, you can see that sovereigns that can't or won't enforce the dues, that won't enforce the payment of the dues, have problems, and they can't enforce their sovereignty, and so that creates problem to move resources to the government. And so what are example of that? If you have an unstable political system, okay, you have a lack of trust in the ability or willingness of the government to enforce the payment of the dues, then you have problems. You have poor enforcement mechanisms, you have tax evasion, you have corruption of tax officials. You have also another source of problem here. And if you have a large informal sector, it's hard to track who is earning what, who is paying to whom. And so again, it's hard to impose your monetary sovereignty and make it work properly. And so that's why we can have countries in which the population doesn't use the national currency for most of its transaction because they can evade the enforcement of the tax payment, okay, and or use it merely for that purpose. And so on the other side, you have sovereigns that have political power that extends beyond their own territory. And so that also increase the ability to create a demand for the national currency abroad. Okay, so today we have the US dollar, okay, that has major influence on international institutions, and so can increase the demand for its currency. So that's the first part about what it is. Now, the question is, how do we implement that monetary sovereignty? And so the implementation today is done through heavy coordination between the Treasury and the central bank. And the goal is to ensure that overall government operations run smoothly without disrupting the payment system. So what do we want to do? What do we mean by government operations? You have monetary policy, which is about setting a policy rate. You have fiscal policy, which is about, well, spending and taxing. And the last one, which is a financial policy, where you want to promote the stability of financial markets by providing enough of the safe interest earning financial instrument. These are the foundation of market pricing in financial markets. Okay, and so what we want to do here is unpack that and look at this coordination a bit more in detail. And the goal is to show that basically monetary policy is routinely involved in fiscal operations, and the Treasury is routinely involved in monetary policy operations. Okay, and so the idea that there is a strict separation between what the Treasury does and what the central bank does, with central bank focusing on monetary policy and Treasury on fiscal, well, in a monetarily sovereign government, this is blurred. So the central bank is involved in fiscal policy by basically ensuring that Treasury auctions are successful. Okay, there is this fear that, well, Treasury auctions could fail and the Treasury could not get the fund it needs. Well, in a monetarily sovereign government, that can't happen. Okay, you have several possibilities here. The first one is the central bank directly provide monetary financing of the Treasury and by at auction directly buying from the Treasury some securities. And sometimes it's allowed, sometimes it's not. Today, basically the Treasury buy the coins from the central bank buy coins from the Treasury. And theoretically or legally, there is nothing that prevents the Treasury to have this 1 trillion platinum coin that it sells to the central bank. But the point is that it's a possibility, monetary financing. The other one is the central bank is a major refinancing channel for the Treasury, because the central bank is allowed to participate directly in auctions to buy new treasuries to replace the one that are maturing on its balance sheet. Okay, and so again, that may vary by countries. In the United States, the central bank can do that, but that's a major channel through which you help treasury financing. And then the last one, and probably the most relevant one today, is indirect monetary financing, where you put an intermediary between the central bank and the treasury, and in the middle you put primary dealers or gilt-edged market makers in the UK. And so the primary dealers buy from the treasury, but the central bank is behind ensuring that these primary dealers have the funding needed to buy the treasuries. Okay. Treasury's involvement in monetary policy comes through debt and cash management tools. So on the debt management side, basically the public debt is managed more broadly than just fulfilling budgetary purposes, and sometimes run counter to a mere budgetary logic. So you issue public debt sometime to ensure that the central bank can target the interest rate. We saw that recently during the Great Recession, where the Treasury issued bills at the request of the central bank. And we saw that during World War II also, when the Treasury again issued Treasury bonds. And remember, the context at that time is that you have yield curve control. So the central bank is targeting all interest rates, and it was running short on the long-term maturity. And so it asks the Treasury to issue some Treasury bonds to help targeting interest rates. Okay, so that's the first way the Treasury helps. It issues securities outside its budgetary needs for the purpose of helping the central bank target the interest rate. The other one is the financial stability. Okay, you want to ensure that there are enough treasuries to make sure that the liquidity of the treasury market is maintained. And so again, we have several experiences of that. One of the recent one was in Australia, where the US Treasury has been running surpluses for almost a decade. And so from a budgetary perspective, it's strange to go issue treasuries, but they did. Okay, they did issue treasuries, and the argument was that the treasury market is shrinking, the supply of treasury is shrinking with all these surpluses, and that's creating a problem for the liquidity of that market. So we need to keep issuing more to ensure that the market works properly, because that market is at the foundation of the rest of the financial market. Okay, and so what you have here is a management of the public that is quite different from a budgetary perspective, but is related to monetary policy and financial policy objectives. So broader macroeconomic goals. You also have cash management tools that is used by the Treasury by transferring funds between private accounts and its account at the central bank to ensure that basically the amount of reserves in the open market is in the banking system is consistent with the interest rate target that the central bank has. Okay, and again, we have quite a few examples of that. The most recent one was during the Great Recession. Okay, and so here is the graph for the Great Recession. So the context here is a central bank that in late 2008 was still targeting an interest rate above 0, but at the same time was starting to issue large quantities of reserves in the banking system. And so it needed to drain these extra reserves to maintain the Fed fund rate on target. But at the same time, and so the way it did that first was by basically selling treasuries to banks. Okay, so its outstanding amount of treasuries on the balance sheet of the Fed fell quite quickly, and the Fed was fearing that it would soon run out of treasury securities. And so it asks the Treasury to issue T-bills to help drain the extra reserve. And also the Treasury moved funds from private bank accounts to its account at the Fed, draining more reserves. And so what you have here is, so you remember we have the context here is Lehman Brothers collapsing, and so panic in the market. And so board reserves go to the roof to $700 billion. Okay. At the same time, okay, you have the Treasury draining about $600 billion worth of reserves with the goal of explicitly helping the central bank maintaining its interest rate on target. Okay. And so that's an example of a recent coordination to help achieve the interest rate target. There is more routine involvement beyond that, especially prior to 2008, when we don't have a large amount of excess reserve and we don't move toward the corridor system, where basically the Treasury and the central bank talk on a daily basis, okay, and help each other achieve the desired outcome of maintaining interest rate stability. So what are the implications of that? Well, the first one is that there is no financial constraint. Okay, so we can afford to buy anything available for sale in the domestic currency. And so that is recognized long ago. Okay, so here is Keynes, okay, a government which has control over the banking and currency system can always find the cash to pay for its purchases of home produced goods. Greenspan recently, again, there is nothing to prevent the federal government from creating as much money as it wants and paying it to somebody. Okay. Where MMT goes a bit further is that if you start thinking in terms of the federal government, so a consolidated view, it's not that the federal government can, is that it must spend by creating money. It's not an option. But we can leave that for later if we want. The monetarily sovereign government also can now be forced into a default on its debt denominated in its own unit of account. Okay, the default is purely voluntary, and it's quite rare if you look at the data. Okay, the government has control over the cost of the public debt, and it can choose to enforce that control more or less tightly. And again, we have experience of all that throughout history, from focusing on the short hand of the market toward the long hand, if we want. So the public debt is managed for broader goal than just budgetary goals. And as I said, the management can be contrary to a budgetary logic. And again, here we have Foley and Juvenal from the Federal Reserve Bank that says that as the sole manufacturer of dollars, whose debt is denominated in dollars, the US government can never become insolvent, i.e. unable to pay its bills. In this sense, the government is not dependent on credit markets to remain operational. So fiscal deficits are normal, okay, and they are sustainable. So normal, why? Because they reflect the fact that other sectors want to be in surplus. Remember, we have this accounting rule that says that the domestic private balance, DPB, plus the government balance, GB, plus the foreign balance must equal 0. Okay, that reflects the idea that is similar, that for every debtor, there is a borrower, for every buyer, there is a seller. Okay, from every income earner, there is a spender. So this is what this identity is reflecting. Okay, for every person that is in surplus, there must be someone that is in deficit. And so usually other sectors want to be in surplus, so the government has to be in deficit. And this is sustainable as long as you have monetary sovereignty, because monetary sovereignty basically gives you 1 degree of freedom in this tight accounting rule. It allows the government to sustain deficits. And usually the stationary fiscal position is one where the government is in deficit because other sectors want to be in surplus. And so what that means is, of course, that the fiscal balance is not a proper policy goal. Okay. The automatic stabilizers will make sure that austerity is self-defeating, unless, of course, the other sectors are willing to deficit spend. Okay, in that case, it will work. But usually that's not the case. And so if you try to implement a tax reform that raises taxes or cuts spending through the automatic stabilizers, you end up going back to the same position or even worse than where you were prior to that in terms of fiscal balance. And so there is also no fiscal autonomy that is gained from trying to balance the budget. And so here are examples of data that shows you that throughout time. So the gray areas, it's basically showing you a graphical representation of the accounting identity. On the y-axis, you have the domestic private balance. On the x-axis, you have the foreign balance. And both of them can go on surplus or deficits. And the way you represent the government balance is through the 45-degree line, and the gray area is the place where the government balance is in deficit. Well, throughout the world, you can see that government balance over time is the norm. Okay, that's where we are. Another norm is also that the domestic private sector tend usually to be in surplus. Okay, but fiscal deficits are the norm, and they are sustainable if you are monetarily sovereign. So here is some data about the interest rate, fiscal policy, and monetary policy. So on the left side, you have the fiscal position on the x-axis and nominal interest rates on the y-axis. And you can see that if we had a crowding out effect story, we would have something like that, where the more you go in deficit, the higher the interest rate will be. So we would have an inversed 45-degree line dot plot. Okay, that's actually not what we see at all. Okay, we see basically, if you look at the coefficient correlation, there is no relation between the fiscal position and interest rates. So the fiscal balance itself has no or very weak relation to interest rates. So crowding out story goes out of the door. If you look on the right side, we have plotted the federal funds rate and nominal interest rates. And here you can see that you have a very strong relation. It's very tight for short-term rates. Okay, it's almost a 45-degree line, so correlation coefficient is almost 1. For longer term rates, you have a looser relation, but it's still quite strong. Okay, so what the message is here is that the key driver of interest rate is not fiscal balance, it's monetary policy. Let's see, I have 2 minutes. So the implication here is that what should the government do? Well, that becomes a question of what is the public purpose, and that's a political question. And so MMT sees a lot of socioeconomic challenges where the government can help: unemployment, unfair inequality, aging society, climate change, pollution. And so none of those are solved through financial means by putting money in a lockbox through a fiscal surplus or having a trust fund. Okay. You have issues of unlimited capacity to spend doesn't mean that you should spend an unlimited amount, okay? Because you have inflation risk, you have waste, you may decrease incentive to work. And so what you want to work on is not only the overall spending level, but this type of spending. And monetary sovereignty does not apply only to the United States. Okay, what is special by the United States is that there is a foreign demand for the currency, and so the foreigners want to have a surplus vis-a-vis the United States. So what that means is that the government balance usually has to be more in deficits than it would otherwise have been. Okay, some economies, and Fidel touched on that, have limited domestic resources, have limited ability to impose and enforce taxes, have foreign demand for their currency that is zero. Well, in that case, the fiscal balance will be much smaller, and the ability of government to be involved in the economy also will be much smaller. Okay. And so to conclude, okay, in a monetarily sovereign government, the legislative branch must still pass a budget, okay, because a budget is important to develop what the economic priorities are, to promote transparency and accountability. You must still tax because you need to fulfill budgetary and microeconomic and monetary goals. And you must still issue bonds for budgetary and fiscal stability goals and monetary policy goals. Monetary sovereignty implies that bond vigilantes, credit rating, and the fiscal deficits are very limited to no impact on the cost of the public debt. And so that government has the financial flexibility to spend where it needs to spend. And that becomes a political questions. And so the public debt, again, is managed for macroeconomic purposes. And so monetary sovereignty, I'll finish, that does not imply that you can spend carelessly, and doesn't mean that we have to have direct monetary financing of the treasury. So we hear often that MMT is for monetary financing of the treasury. That's not at all what we want. Okay, we acknowledge that government finances, the way they work today, works very well, but what we want is reorient government toward a better discussion of the public purpose to meet the challenges of our time. So I'll stop here.
Thank you very much, Eric. Thanks a lot. Based on the computer, the time on my computer at the moment is 18:04. But still, we have a kind of break. Let me see. We have a 15 minutes break. So 4 minutes past that, so we have 11 minutes break. And at after 11 minutes, we come back. So 18:15, we come back for the second section, which is a panel debate for 75 minutes. And after that is a Q&A questions for 30 minutes. Thank you very much.
Wait, how long do we have?
About 11 minutes.
Oh, okay.
Sorry for the background noise a little bit because the fan of my computer is making that noise. Hopefully it's not very disturbing. Okay, just a few more seconds until Roger comes. One more time, I apologize for the background noise of my computer. The fan of my computer is working hardly. I don't know why. Oh, that's great. Thank you. Okay. Thank you very much for all your thoughts that you shared with us. Now, we have some questions from different people. So if you let me, I read the first question. So the first question is for all the panelists. In the case of the COVID-19, which one do you think is more effective right now, specifically in the developing countries, to stabilize the economy first through the monetary policy to prevent the market disruption, or boosting the economy through increasing the debt? Who is going to answer this question first?
Well, I'm happy to go first, and then others can add to this. I think it's been very clear that monetary policy was unable to address the economic slowdown or economic recession, and most governments understood this. Most governments went for economic relief via fiscal policy. The problem is that, given the extent of the pandemic, the economic relief has been temporary, has been relatively small, and by now we're 7-8 months into this. Most governments have given up on the idea of increasing economic relief, and a lot of countries had to kind of give up on this and reopen the economy. And now we're facing the second wave in many parts of the world, which calls for yet another massive economic relief package from the fiscal policy side. I'll give you the example of Tunisia I mentioned earlier, which is a very interesting development that not a lot of people are paying attention to. In Tunisia, certainly people are paying attention to. With the economic, quote unquote, relief package that the IMF provided to Tunisia post-revolution, it was conditional upon the parliament passing the law to affirm central bank independence. And that's a law on the books. And as of the last few days, the central bank and the government have essentially ignored that law and went into direct central bank financing of government debt, which is raising a lot of eyebrows right now. And the government essentially and the central bank is just ignoring it because there is no other way. And it's a temporary thing. It's not the whole package of policies that I was talking about earlier, but it's just countries are backed into a corner where there is a recognition that there is no other way than direct economic relief from the government. The question is, how long can we sustain this without structural policies that actually address the issues that I highlighted earlier?
Yep. I agree with Fidel. I think it has to be on the fiscal side. People lost income, and the only way you replace that is through a fiscal lever. But we definitely need something much more structural than what is going on now, which is very ad hoc. reflects basically the administration that doesn't believe in or doesn't want to believe in the seriousness of the problem, basically. But yeah, monetary policy, it's the financial stability side of the problem is for monetary policy, but the income side is the fiscal side.
So I throw in here the biggest questions with COVID are not so much, well, partly how you compensate people who, by government fiat, you say can no longer participate in market activity. But the much bigger question is, do you do that in the first place at all? And we've seen one experiment, for example, in Sweden, where the answer to that was not very much. And we've seen other places where the lockdowns have been really quite draconian. And we're now seeing massive social unrest, even in places like Spain and in Italy, in response to attempting to prevent people from market activities. But to the extent that we make a collective decision that there should be some people who are prevented from engaging in interacting with each other in market activities because we deem that the rest of us in society are better off because of that, we clearly have a social responsibility to compensate those people. And in countries where it's possible to do that through monetary sovereignty, then print the money and give it to them. That's my response. But the danger is that we are unable to withdraw that support once we've solved or once we're out of the immediate COVID crisis.
I don't think I disagree with anything that's been said. I think it is important to distinguish between relief and recovery because relief payments, of course, we don't want to see them go on forever. But recovery in this case may not be something that can easily be achieved with any kind of fiscal policy, apart from contributions to the development of a vaccine, of course, and that sort of thing. But that's the only development, that's the only sort of development that will bring real recovery on. In the meantime, I agree with those who said that we need fiscal policy at very least to allow people to continue to have a means for surviving and not being terribly impoverished. I think the Federal Reserve's monetary policy responsibilities here are actually rather limited in that monetary policy in the zero lower bound situation we're in is not particularly powerful. So there again, I think at very least, you have to have a coordinated fiscal monetary response. So I agree with all of that. The only thing I would add beyond this is that ultimately, when we do come out of the crisis, there has to be some attention to the long run responsibilities of containing growth beyond just the short containing the growth of spending. Once it revives and picks up the slack that it has lost, that it has witnessed in the last few months. And that's going to be when some difficult decisions may have to be made about controlling inflation, possibly. I don't think this is a problem for some time, however, and so it isn't about the crisis per se, it's about the long run best policy for maintaining inflation.
Thank you very much.
May I add a quick comment on the US case here, not developing countries. But in the US case, for example, that I think it was mentioned earlier, the airline industry is not expected to recover by all forecasts, not anytime before 2024 to pre-COVID capacity. So in the meanwhile, what are we going to do with not only the hundreds of thousands of airline employees who are currently being, in the process of being furloughed, and with the, for every job in the airline industry, there are 6 or 7, maybe 10 other jobs in the related industry. So we're talking about millions of people who are facing foreclosures, facing evictions, facing all kinds of economic stress. So economic relief versus recovery, and then thinking about the pandemic situation with all the needs in other areas of the economy. So you have the potential of a small army of contact tracers that can be employed, people with customer service professional skills in the industry that can be deployed today for that purpose. You have every single airport in the US has a small army of food prep people, of drivers, of logistical capabilities that can turn into the best Meals on Wheels program in the world to deliver food to the vulnerable, to deliver food to the elderly, to people who are, are left with no access to jobs and the rest of the economy because of the pandemic. You have in the Great Depression, during the WPA administration, WPA employees paid 32 million visits, home visits, some of which were wellness checks on elderly people, wellness checks on mothers who recently delivered, wellness checks on children, and provided kind of basic health wellness checks and assistance for people who are sick at home for other reason and couldn't have another family member take care of them. These are things that were done on a massive scale with pen and paper logistics in the 1930s. I think we can do much better in transitioning people, at least temporarily, into this kind of economic relief and recovery employment.
Fidel, I agree with a lot of that. I'd have a question for you on that. So you're pointing out that there are a large number of temporary jobs that need doing. I say temporary because I don't perceive that contact tracing is something that is going to last 5 years in a big way.
Sure.
You're saying that there are lots of employees who are temporarily and possibly permanently unemployed. For example, the caterers you're talking about in the airline industry. But the logistical question is what you do in a market economy to solve the problem of reallocating those people either temporarily or permanently to other occupations. And I would personally be not a big fan of setting up government programs to do that, because those government programs are likely to become very difficult to disassemble after the fact. I mean, you could imagine a massive government agency that was, the COVID-19 response agency that then had its own advocates in Washington, its own employees, and then a couple of years from now, when we no longer need it, difficult to know what to do with it. But I'm hoping there might be ways of carrying out what you're suggesting through private.
Yeah, what I'm suggesting is definitely not government agencies taking over the airline industry per se. And we have practical examples. Singapore has actually provided quite a few of these examples of their airline employees moving into not Meals on Wheels programs, but home delivery of food. They even do first class delivery for a very expensive price. The airlines by themselves, without government. This is the airlines trying to stay in business and essentially reallocate it. They started with something very silly, which is the flight to nowhere, because there were people who wanted to fly.
I remember that.
And then they canceled that. Now they moved into using their food prep and flight attendants to deliver airline meals to people at home, first class, very expensive price, but also they opened their actual airplanes as immobile restaurants with social distancing practices and so on. They also transitioned some of their employees to work in hospitals. Contact tracing was in one area, but also hospital assistants. Because you have to remember, airline employees are also first respondent in the air. So they have basic training.
We're at a fairly dangerous moment in this whole thing right now. I mean, I've been locked down in Los Angeles since March, and I used to live in an area, I do live in an area that used to have thriving restaurants everywhere. And now when I walk out on the streets, I would say probably half of those are closing right now. They tried to keep going temporarily with relief. There's no more relief coming, and that's a whole lot of people that are going to have to be permanently relocated. So in terms of relief versus recovery, there are two stages to this whole process. The first was we laid off a whole bunch of people temporarily and then brought them back again. And that much, so we saw a 30% decline in GDP and then a 30% increase in GDP. And remember, 30% from a base of 100 is not the same as 30% back from a base of 70. So we're still a big hole, but that hole is now, we're now much more back into a situation of a normal, I say normal, but a normal large recession in which relationships have been broken permanently. And the people who are now lost their jobs, the people who are running small businesses, the people who were employed in those businesses, the people who were employed in the airline industry, they're going to have to be relocated. And that takes a lot longer. So the next phase of the recovery, I think whatever happens, even if we start pouring more money in, it's going to be slower than the initial bounce back.
I think it's important to remember that in the 30s, we didn't have unemployment insurance.
Yeah.
So these relief programs like the WPA, where that era's or the New Deal's alternative, because there had been nothing at all before. And then Roger's point about long-run recovery basically raises the question: which of these approaches is going to allow this long-run allocation to take place soonest? On the other hand, when people are just receiving unemployment relief insurance, they may not be doing anything productive in the way that they would have been if they were in the Civilian Conservation Corps, but they can also be available for grassroots programs that seek to take advantage of their availability that way. I think it's a very interesting question, and it's not obvious to me how much better off we'd be if we tried to do another WPA instead of, or as an option to people just taking unemployment. But I think it's a kind of thing worth discussing.
I'd say there's another whole thing coming down the pipeline in the US right now, which is almost certainly going to be massive layoffs in local government. We've seen the tax base in Los Angeles, in New York, and in San Francisco is rapidly evaporating. Those cities are in deep trouble and are now talking about laying off large numbers of public employees. So there is a second wave coming down the pipe.
Absolutely. And it's not a question of either or. I mean, it's clear that the so-called recovery in the last couple of months is tapered off. We've seen it from the most recent unemployment number. So some of the jobs that were lost are now lost permanently. And we're going to see this continue for the next couple of years, in addition to the fiscal imbalances that states and local municipalities have, which will also add to this burden. So to me, what we're talking about here is there are some jobs that can be transitioned, reallocated temporarily during the COVID crisis. And that's why I mentioned the airline industries as an example, contact tracing, but that's definitely not going to absorb all the unemployed population. Unemployment insurance also is time limited. Economic relief from Congress, as we've seen, is also time limited. And Republicans, including some Democrats, also think that this can't go on forever because they worry about the fiscal imbalances and so on. What I'm talking about is a stepping stone towards a job guarantee system where you have a buffer stock of employment, because this is a structural issue that we had pre-COVID and during COVID and post-COVID. We're still going to have these individuals who leave the labor market for a variety of reasons. And the longer you're unemployed, the less likely you are going to be picked as the most competitive person in the job market to compete for.
Can you say something about Can you say something about how a jobs guarantee program would work? I know this is a big platform of MMT, and also maybe discuss a little bit its connection or advantages or disadvantages relative to a negative income tax.
Right. That's a big one now. They added the second one. So a job guarantee would be federally funded, locally implemented. In other words, what you want to think of is local communities through municipalities, through NGOs, kind of make a long list of things that need to be done at the local level because they have the best knowledge of what is needed. The federal government provides federal grants through the standard mechanisms that we have today. The community will match then the needs of the community with the skills of the local population as needed. And if the skills don't exist, you do on-the-job paid training to transition into building up those skills and implementing those programs. Now, some programs need to be implemented at the federal level. If we're talking about broadband infrastructure, it's not local municipalities that's going to do this. If we're talking about, something like the CCC or the WPA, so some national programs to boost infrastructure quality across the country, followed by a jobs program for people who want to work but can't find employment. So that will be the local job guarantee component, followed by a third layer, which is a generous income support system for people who can't work or shouldn't work for health reasons and such. So that's where the income support comes in. I'm definitely not in favor of a UBI alone as a mechanism for this. Even during the pandemic, I said it very clearly, the most important job for people to do is to stay home if you can't go to work safely. And that's a job guarantee paid to stay home, right? It's not an endorsement of UBI as a permanent policy. So I'll leave it at that, and maybe Eric can add comments here too.
Yeah, the goal really of a job guarantee program is that we see value in using unused labor resources to fulfill the public purpose. And so if we go back to a comment of George, do we see value in doing what the WPA did? We definitely see that. I think the experience of the WPA and other programs showed that there were large benefits for the population. The CCC was extremely popular. The WPA had a hard time, but over time gained more popularity because they were able to basically implement a better program over time. They gained experience. Remember, at this time, the frame of thought of the policymaker is those are temporary emergency program. And so it lasted 10 years, and they figured out over time that, well, probably it's not an emergency. We're going to have to work those out a bit better. And so the implementation of the program improved over time, and the accountability of the program improved over time.
The CCC had a very good reputation, it's true. The scale was small though, and I think it made it easier for them to manage it well. Of course, good personnel counted also, but it was a very small program. The more you scale these things up, the bigger the challenges become to try to make sure there's not a lot of disorganization and waste.
The WPA improved over time.
Yes.
The National Resource Planning Board, basically, which is a main major report at the time, took a long time to get that, is basically clearly showing that. Okay, so yeah, there is value into a job guarantee program because the alternative is basically people stay at home, do nothing, and we have lots of problems to solve where you could use that labor, basically.
As long as they keep on looking for jobs. That's the one thing you want to make sure continue.
They can, sure. Yeah. So you want to leave, again, you're free to leave whenever you want. Yeah. So it's not a program where you force people to come in and force them to stay, and they can therefore.
No, I meant that they have an incentive to look for jobs.
Sure. It's a public option in the job market. I just added in the chat box here a link to Reimagining Appalachia, which is a regional movement that I'm involved in. It's essentially calling for a new deal for the region, for Ohio, Pennsylvania, West Virginia, and Kentucky. And there's a number of studies that are linked in there. And that includes a modern day CCC program. That includes broadbandification of the region, of the country, I should say, just like we did the rural electrification. If the future of the economy is digital, is artificial intelligence, and we're systematically excluding people from access to information in rural areas, then how can we turn around later and blame them for not having the skills to participate in the new economy and so on? So it's really about building up the infrastructure. And there's, we have, the planet is on fire. We have millions of people who want to work, and we have, renewable, clean technology available is becoming more efficient and cheaper by the day. And we're sitting on our hands and saying, we can't do anything about all these crises. And what we're saying essentially is that, these things can be done, again, federally funded, locally implemented. So the selection of the projects, the implementation, the hiring and firing, the training, the assessment, through, all the checks and balances and transparency standards that we believe in, can be done. And this is what this group is essentially calling for, is saying we at the local level know what the needs are. We've designed programs. We need federal funding to boost infrastructure and boost the region. So lots of examples like this all over the place, but this can't be funded at the city level or the state level, and certainly not during a pandemic.
Okay, thank you very much. There is another question. Is there any optimal debt to GDP ratio?
Yes. I answered that in the chat box. So this is a pet peeve of mine. So everybody, we teach macroeconomics to graduate students. We've been teaching macroeconomics to graduate students for 20 or 30 years or more, using a paradigm of a representative, infinitely lived family. And there's been a lot of discussion recently about debt. And the debt of the government is not like the debt of a family in any way whatsoever. It's much more closely related to, I mean, what debt does, and money is debt, is it connects people today with people in the future. And the people, when the government raises debt to purchase things or do anything with, the people who pay off that debt, to the extent it's ever paid off, and typically it isn't, are not the same people. They're people who are not born yet. And there's a whole class of economic theories that are relatively mainstream, called overlapping generations models that study that. And if any of you, if there's any graduate students or interested people out there right now, I've been teaching a second-year graduate class on this topic, which you can see my lectures by going to my website and registering and downloading them. Those models of in that class have a lot of potential for unifying, I think, some of the concepts that MMT people have been talking about and mainstream people have been talking about. And so back to the question, is there an optimal debt to GDP ratio? The answer in those models is yes. And it's the one that equates real rates of interest to growth rates. So it's a well-defined question. It's a quantifiable question. And how big it is depends on measurable features of real economies. But it's certainly not zero.
Or infinite.
Or infinite.
Great. Anyone else want to contribute in this? No? Okay.
Thank
so
you.
Yeah.
Well, I agree. It's not zero and it's not infinite. That's a clear one. The number that you, or the formula that you give, I think of it as a benchmark, not as a hard standard for countries, because I think the reality is much more nuanced than that, especially in developing countries. The other thing I would add to this, and I'm looking forward to looking at your work on your website, there's almost a standard approach in the profession that definitely, reproduced by the work of Rogoff and Reinhardt, that conflates external debt with domestic debt, which is a big problem. So we have to, unpack those separately, because the sustainability, quote unquote, sustainability of external debt versus domestic debt is a very different beast, especially for developing countries.
I agree with that completely. And you won't find anything about that on my website.
Great.
and I would say, I'd add one more thing. I mean, the optimal quantity of debt can be negative as well. It's perfectly feasible for the best thing for governments to do would be to have sovereign wealth funds and owning portions of private assets. So zero is not the answer, but it depends on the circumstances to what the answer is.
Take it, Roger, that would be some pretty special conditions where that would hold, or are they not all that?
No, they're not that special. They're linked to whether really whether we get poorer as we get older in some sense. It's a technical question that I don't really want to get into, but I wouldn't say it's that special. I think the normal case is probably the one where debt is a good thing to have, but it's closely related to this issue of dynamic inefficiency. So that's again a technical question, but it's a question of whether interest rates in equilibrium end up being negative or less than growth rates, and that's a very bad thing when it happens. And when it does happen, there's a free lunch for governments to step in and raise debt. And so it's the same question as our economy is dynamically inefficient.
There's actually a case study that you can simulate probably, which is Saudi Arabia. It has a massive sovereign wealth fund they're burning through it as we speak. Very little external. Right, and then a ticking time bomb, so to speak, in terms of oil reserves, that by most estimates, by 2038, which is the day after tomorrow, Saudi Arabia will become a net importer of oil, not an exporter, which means if you take away the oil revenue surplus, you burn through the sovereign wealth fund reserves and central bank reserves, then you're looking at an economy that's dependent on food imports, energy imports, and has no industrial base.
But I thought the world was going to be oil free by 2035.
Well, that makes it even worse for Saudi Arabia. The sooner we transition, the worse the situation is.
In that case, they can actually import oil from Iran, because at the moment Iran cannot export any oil. Good. Okay, let's go to the second question. It's in what situation would the government choose to default on its payment rather than create more money to pay them?
So I guess I'll go on that. Yeah. So if you look at Moody's and Standard & Poor's have looked at the cases of monetary sovereign defaults, actually. And there are a few cases. Some of them are purely technical cases where they could not find the guy who would keystroke the number to put the debt service. So they defaulted in that sense. There are other cases like Russia that are more complicated, because there what we have is a fixed exchange rate regime. And so they wanted to defend the currency. And so they defaulted on the domestic denominated debt. That's the other cases. So you have a monetary sovereignty that is only partial here, because you're fixing your exchange rate, basically. Yeah. And you have other cases like Hungary recently that had that defaulted not on its domestic denominated debt, but on the foreign debt. So it has two types of debts. Yeah.
So I guess it's important to point out that hyperinflation is a type of default itself.
No. So that's another thing. If you look at the credit rating agencies, the way they define default is in either you don't service the debt or you have an inflation risk.
Mhm.
And I would be very careful in differentiating the two. I don't think inflation is a default because the government usually does not promise a constant purchasing power on its debt servicing. Okay, there is no reason to assume that it's responsible for the inflation. And so those two things are clearly different. Also, if you start to confuse the two things, you enter into issues of, well, okay, tax is supposed to be the main revenue with which you service your debt. But if you have inflation, you have higher tax revenues. So are you more credit worthy or less credit worthy? So it becomes wishy-washy here. It's become strange to if you try to fuse the two together. So I don't think I would put inflation in the category of default.
And the U.S. Treasury offers TIPS, which is the
Sure.
inflation-protected asset. So I agree with Eric that I wouldn't include that as some people call it partial default or default.
But then the point is that I think that's fine to account for inflation as something separate from default, but it means that we have to be all the more mindful of the fact that when the claim is made that a sovereign government need never default, that means that it can always resort to inflation in those cases where that's necessary to avoid defaulting.
Well, the thing is, how do you do that? What do you mean by that? You don't have
What I mean,
an automatic relationship between government spending and inflation.
No, I simply mean that while it may be valid to say that a sovereign government need never default, that may mean that it doesn't default because it has inflation. That's not the only possibility, but it's one of them.
I want to push back against this. I mean, if you look at 1920s Hungary or Russia or Germany after the First World War, I mean, these were defaults in any sense of the word. That people have been holding sovereign currencies when they are worthless. And we're not just talking inflation of 10%, we're talking of millions of percent per year. So that I call that a default.
So, Roger, I think you and I are saying it's a matter of semantics. What I'm saying is you can say that a sovereign government need never default if one of the things that isn't default is inflation.
Okay, I'm on the same page as you.
Say that hyperinflation, I should say. Yeah. Or you can say hyperinflation is default. In that case, we got a lot more examples of sovereigns that defaulted. It's one or the other.
And interestingly, we've got examples and Argentina is a good one, of periodic defaults in this situation. So, beginning in the 60s through 1990s, I think that there were 2 or 3 hyperinflations in which they come back from the brink and then do it all over again. And people are still holding the nationally denominated debt. Those are very difficult episodes to understand, I think. But I would call that default.
I would agree that it's, if we're talking about it this way, that it's semantics.
Important, though, if you cross the different definitions and you get statements like a sovereign government can never default, where some people assume that means that it can never default always without having to without any risk of inflation, which is not the same thing.
So I would qualify what I said. It's beyond the semantics point, that we're not saying that governments with debt in their own currency can never default, and period. And that doesn't mean that it's an endorsement of hyperinflation scenarios. We're saying that governments have a whole set of tools in their toolbox to affirm the fact that they can't default in their own currency, but they also have the tools in their toolbox to mitigate inflation, to address unemployment, to address all these other issues. So it's not a one-dimensional statement. It's a statement kind of nuanced with everything else that I tried to explain earlier.
Yeah, I think if you have cases of a hyperinflation, what you have to look at is the structure of the economy and the political aspect. How the debt side is really not there. So what you want to address is the accountability of your government, the structure of your economy. That's where the issue is when we look at cases of hyperinflation.
But hyperinflation is one of the tools a government can use to avoid default in the narrowly defined sense of the term. It is one of the things that can do that by eliminating the debt, the real debt.
Well, again, what happens is you have default. You're just making it easier to repay. That's all. But default. Remember, when we mean paying, we mean the nominal payment. And there we're gonna go into the legal argument of what is a payment. But we work today in a nominalist under a nominalist principle. So paying just means paying the nominal amount.
Which is
and
different
so you
from
cannot go
Rod's
to court
definition.
and sue the government for loss of purchasing power. In the same way that the government cannot sue people in case of deflation and tell them, hey, now you have to give me back the money that because you have a higher purchasing power. Okay, it's all nominal. So what we want to say here is that, yeah, you can have periods of hyperinflation, but those relate to broader underlying problems in the economy.
No, I'm not sure that you can say that, Eric. One possibility is that inflation is resorted to as a way to avoid default. It can be one of the tools that's used according to your own understanding of what avoiding default means. One way is
you default by you can always pay, because paying the debt is just keystring numbers. That's all.
Okay, and if you do enough of that, and you can have a hyperinflation.
Well, yeah, you could.
Yeah, that's all. It's just one of the possibilities that I think needs to be out there. And to go back to Roger's point, if we define default not Roger's way, but as not paying, then we can say that a sovereign never has to default, but that could be because one of the tools it has available is to create oodles of money to drive its real debt down to zero and pay it all.
Yeah, I would see hyperinflation not as a debt problem and debt servicing problem, but more as something that is due to you have underlying structural problems in your economy, and that's where the issue is.
Yeah,
well, in the sense that countries that have resorted to hyperinflations have had weak enforcement mechanisms for raising taxes, I think that's true. I think I just like to put in a few words here because I'd say that out of the four of us, Eric and Farrell are kind of coming from an MMT, is that fair to say, kind of perspective?
Sure. Yeah.
And I'd say George and I are maybe more mainstream. I don't know if George wants to think of himself as that or not.
I'm anti-mainstream in a completely different way.
Yeah, me too. So I just want to draw some parallels, some points of agreement between at least me and MMT, which is that there's a very broad strand of post-Keynesianism that influenced MMT and which I am in broad agreement with, which is an important idea from the general theory that there can, economies, the word equilibrium can mean being stuck with too much unemployment. And I think that that's I think history for me, when I look at data, I find that as a more plausible way of understanding what I've observed than the quick self-correcting idea. And that does give you room for trying to manage economies in a way that leads to optimal employment. And by the way, optimal employment for me does not mean zero unemployment. This is something I've argued with critics on the internet with a lot. The world is a constantly changing thing, and there will always be some people unemployed. So it's possible to have too much employment as well as too little employment. But it's certainly possible to have too much unemployment. And in terms of the policies, one of the questions that I didn't have time to answer had to do with automatic stabilizers. And there, what I think is important is to design institutions, not so much rules, but institutions that react in good ways to try to maintain what we would think as a socially good outcomes. I think the move to inflation targeting in the 80s and 90s in many world countries appears to have been such an institution that worked relatively well. I think that the reason I call it institutions rather than rules is because there's another big debate in economics, which is rules rather than rules or discretion. Should you have policymakers follow mechanistic policy rules? If X happens, we do Y. And there I'm very much in favor of discretion. I think that designing institutions where there's some flexibility for policymakers under political control to take decisions that are different as the world evolves is very, very important. Because again, I keep coming back to Keynes, but another important point that we seem to have forgotten from the 20s and 30s is that we do not live in a stationary environment. The world is changing in ways that are completely unpredictable. And the best way to try and handle that is by having some flexibility in the people who are making decisions. So.
Roger, if I can respond to that, I'm not, I'm sympathetic to rules, but I think that answer, but not completely. I have my doubts about them. But that answer, if it frankly won't do. It's an answer that would be perfectly valid if the argument for rules were simply that, oh, we don't need to respond to anything, we can forecast it all in advance. If that were the argument, well, it's easy enough to show that it's false. The argument is that given discretion, discretionary policymakers use it to do the wrong thing. That's the argument. That is, when they're faced with the situation where they have to decide how to act, they get it wrong. And so Friedman's argument, to defend it just for the sake of discussion, was not that policymakers couldn't do a better job than rules allow them to do. It's that if you gave them the freedom to do a better job, they'd probably do a worse one. That's the argument that has to be confronted.
So do you think, for example, that the Bernanke Fed did a bad job in handling the great financial crisis?
Yes, I do. Eric, I'm going to need your help here, or I'm going to draw on you. If we go back to Eric's discussion of monetary and fiscal policy coordination in 2008, we don't need to look at the slide, but what Eric was describing then was this ridiculous sterilization effort where the Fed's balance sheet was growing. This is early on. This is before QE. This is 2008 mostly. The Fed's balance sheet is growing because of emergency lending. And it is concerned about maintaining this ridiculous Fed funds rate target, which in retrospect was too high, much too high. In fact, they failed to maintain it. So what are they doing? They're selling off their bond holdings to offset the lending. When they can't do that anymore, they're having the Treasury park oodles of money in its TGA or in the special account created for the purpose. Basically, they're sucking the liquidity out of the whole rest of the financial market to give it to these fat cats, mostly, who they were making emergency loans to, all in an effort to keep a Fed funds rate higher than it should have been. So yeah, I think that's a great example of where discretion went awry. Now, wait a minute. I have to admit that doesn't mean that I have a rule that would have worked better in that place. I can come up with one retroactively. Right. That's easy. I do join with those who claim that nominal GDP targeting would have been a better thing for the authorities to have focused on then and now. So that would be my answer. But the point is, it's easier to show how discretion goes wrong than to make the case that an alternative rule would have worked, not only that time, but in general.
So let's go back to that point. So in terms of nominal GDP targeting, for me, the devil is in the details. How would you implement it?
Oh, goodness. Well, I'm not the best person to supply those details, but I will say this much. I don't think it's any harder to implement than price level targeting or average inflation targeting or anything like that. It is simpler in the sense that it tells the authorities that they shouldn't worry about real output. They shouldn't be concerned about stabilizing the price level in response to supply shocks. They should just be looking at the flow of spending.
I'm totally on board with you. If you take, say, Scott Sumner, who's been a big advocate of this.
Yeah. Well,
but his position was that to implement nominal GDP targeting, you should directly intervene in the nominal GDP futures market. Now,
well, that's right. If you've got a good futures market,
it's a very thin market, but it's very similar to the position I've been taking, which you should intervene in an indexed fund in the asset markets, because they are very closely correlated with nominal GDP. But unlike Scott, who sees that as a replacement for inflation targeting, I see that as a complement to inflation targeting, precisely because I see the real economy as being something that can be stuck at the wrong point. So if you're using one instrument, which is money interest rates, to try and control inflation, and another instrument, which would be nominal GDP futures, or in my case, the asset markets, you can potentially get a handle on both targets at the same time.
Well, yeah, I can't answer for Scott, but my understanding is that, so the interest rate is an instrument, right? Mm-hmm. What Scott's talking about is still about interest rate targeting, and so you can't target the interest rate at two different levels according to two different goals. You still have.
No, but you can target nominal GDP growth at one rate and interest rates or the inflation at another, because because we as long as we have an interest rate instrument at the Fed, we have to set that at whatever level achieves the NGDP target. If we set it at the level that does something else, I disagree completely. And the reason I disagree.
What does the Fed change when the NGDP is growing so slowly? What does it adjust? I say right now it would have to change the interest on reserves.
No, I say it would need to intervene in the asset markets by putting a ceiling and a floor on S&P or some stock market index.
And wouldn't that change interest rates?
No, I'd say the interest rates can then be set independently of that. Mm-hmm. So one has to do with the size of the nominal balance sheet, and the other has to do with its risk composition.
I'd have to think about that, but I would only add that I don't see any reason why we ever want to worry about the price level as long as we've got stable NGDP growth. But you're thinking about asset prices, and I'm thinking about the general price level.
The reason I'm worried about asset prices is because historically, asset prices valued in real terms are incredibly heavily correlated and causal in a Granger sense for unemployment. So, yes, wealth and employment move hand in hand. And if you get at, my view is that it's a causal relationship caused by essentially market psychology. And if you can get a handle on real wealth through stock market changes, you can get a handle on the unemployment rate 3 months later. And that's independent of any position you might take about inflation.
We might continue this on the side so as not to be guilty of crowding out. Assuming MMTs believe that we're capable of crowding out, But I would say the question then is whether if you stabilize nominal income, that also would tend to stabilize asset markets. I think it would, but we can talk about this separately.
Great, thank you very much. There is another question. The entire purpose of the labor market is to allocate certain labor, which, what is that question now? Oh, okay, sorry, repeat the question again. The entire purpose of the labor market is to allocate certain labor which has certain skills to the right occupation, which is what we call that matching. How would such a job guarantee match the skills of the unemployed to the public programs? Eric, do you want to?
Yeah, okay, sure. I think the spirit of the job guarantee program, the goal of the job guarantee program is not to do that. Okay, we can try to match as best as possible and use people to use the skills that people have, but ultimately what we have here is the job guarantee program is the base case is to be a program that is involved mostly low skills social programs. If you want to increase that to infrastructure building and all this, that's a much broader program than a basic job guarantee program. And again, if you take the look at the New Deal experience, matching skills was difficult to do. Okay, we were able to use some supervisors that had the experience to guide others. Okay, but usually educated, skilled people were in jobs that were not skilled, but that's okay. What we want to do here is through that program is a lot of it is working through fulfilling basic social needs that don't require that much skill. For the people who have no skills, this is also a good program because they learn on the job. Okay, if you're building houses, you're learning carpentry. Okay, you're also learning to have a job. That's probably a skill that people lose when they stay unemployed for a long time. Showing up on time, being productive, being responsible. These skills have to be kept up, basically. And so that's what the job guarantee program does. A job guarantee program can include also a training program to retrain people. So this skill issue works through several things, but I think that the idea that we should be worried about matching skills all the time is not the right way to look at it.
I would add a quick example to what Eric just added here. We already have working models of this at a very small scale that can be replicated and scaled up. Habitat for Humanity, for example, is a wonderful program that essentially recruits volunteers with zero construction skills. My own students who never held a hammer in their lives are brought on board as volunteers, and within 6 months, they put together home renovations, they build homes from scratch. Of course, there's professional staff, managing and providing the quote unquote on-the-job training. You can think of that same model instead of relying on volunteers, bringing in local unemployed individuals with no prerequisite skills and doing on-the-job paid training to decarbonize the economy, to weatherize homes, to build affordable housing. And this is just one area. So it's really a question of creativity, ingenuity, of designing, effectively designing models that can take people as they are, where they are, do on-the-job paid training, and transition into private sector jobs as needed. Because after 6 months, after 1 year, after 2 years of doing this, now you have potentially certification for installing rooftop solar, carpentry certification, plumbing certification. So now you're at a much higher level of employability and competitiveness in the private sector to transition into your own, contracting business and things like that. But it's really a question of, if the private sector was going to do it, there's no way that those individuals will have a chance. because what we're telling them is go get the training on your own, get the experience on your own, pay for it out of pocket, and then maybe you'll be able to compete in the private sector in the middle of a recession, in the middle of a pandemic, to transition into full-time employment. So it's these kinds of ideas that we're talking about.
Much. And I think we have the last question. That one was a question we asked from Roger in the beginning. If the Eurozone crisis and the great financial crisis were permanent negative shocks to Eurozone economy, this is as a question. Is the Eurozone crisis and the GFC were permanent negative shocks to the Eurozone economy? And if the EU and European Central Bank are making better policy decisions in response to COVID-19 than they did during previous crises?
So I'll answer that briefly. I think any shock is potentially permanent. So when you live in the world that I do of multiple equilibria, you can shock the system and it just stays where it is. So potentially, yes. Has the Eurozone response been better? I think that all of the institutions that we work with, central banks, governments, we're learning over time. Although we're always learning in response to past crises, the accumulation of the knowledge institutionally and socially that we have stored up, it is leading to improved decisions. Does that mean we won't make bad decisions? No, absolutely not. And the Eurozone and the ECB has a much harder time than the United States or the United Kingdom or Japan, precisely because it's a loose amalgamation of nation states with no fiscal central authority at the moment. And there's an ongoing crisis in Europe, which will either result in the solidification into a federation much closer to the United States, or it will collapse. And I've been predicting collapse now for 20 years and it still hasn't happened. So perhaps they'll get it together. I don't know, but it's an ongoing issue for Europe.
That's great. Thank you very much. It's the end of question because one of these questions at the moment I have, we asked this one before. So if you don't have anything else, or if there is no other questions, so we can actually terminate this session. It was really great opportunity for me to see all of you and to hear all of you. And also, Eric, do you want to add something at the moment? Eric Decker, I mean.
Just thank you for everything. That was a great session, and thank you for having me.
Thank you. There is another Eric as well, so.
Yes, well, thank you very much, everybody, indeed, for participating and for joining us today. Before we go there, I'd like to sort of like take a screenshot, a conference photo, if you like, of the people participating. So we've got a little memory. Even though we're not in person, we can still sort of like have a photo. And yeah, that would be the end.
That's great.